Welcome back to another episode of What's on Your Mind, and it's a bit of a special one today. We've managed to get hold of Edward Shek and Anthony Iser, who are both currently over in Thailand conducting a mentoring program for the latest cohort of ITPM students. Guys, fantastic to have you. I trust it's all going well out there.
It is, Chris. And Ed, is it hot?
Ha! Hot as a CPI. It's great to be here. Welcome from Phuket.
Good stuff, guys. Why don't we start with you today, Anthony, and you kick things off for us?
Sure. Here's my beer, a little bit of froth. The froth is out of my beer, and the froth is out of the market as well. So as you can see from this chart here, NASDAQ year to date, down 20%. That's the worst it's been in 30 years, the worst start in 30 years for the NASDAQ. And that's including, the big post-tech bubble sell-offs in 2000. So I thought that was pretty bad. But then I had a look at this next chart, which is the bond market. And it's normally the safe haven when equities are in trouble. But this bond index, you can see here, the Bloomberg Global Aggregate Index, down 10% year to date. It's not even close to the second worst over the last 30 years. This is unprecedented on a level where I think it's almost unimaginable if you had have spoken to bond investors 6 or 12 months ago. So $68 trillion worth of bonds, 28,000 bonds make up this index, down 10%. Annualized volatility is normally only 2.5% for this. So quite concerning. And obviously rates, very much at the forefront of things at the moment.
So I'm also here looking at the bond market. I'm keeping an eye on the terminal Fed funds rate. And obviously after the initial bond market rout, the terminal rate is still inching up, sort of nestling between sort of 325, 335 at the moment. Well, I think this is interesting and quite important. So when we came out of QE 2016 through 2019, obviously the market was lower, valuations were lower, and central bank balance sheets were lower. So the Fed got all the way up to 2.5%, and it really started to impact growth negatively. And throughout 2019, they were cutting rates all the way back to 175, obviously when we entered COVID. So I think it's very important to keep an eye on this, because in the second half of this year, it's going to really drive what the makeup of your account's going to be and how you're going to trade technology versus industrials. So I think, if we get anywhere near there, well, I don't think it's actually that likely. I think the Fed funds terminal rate is too high, and I think we're going to start to see a slowdown in growth as we get up towards 2%.
Spot on, Ed. And I think, we're seeing that slowdown in growth globally already, and that's going to flow through. So the other part of the world that I've been keeping an eye on is China. We know about Shanghai, Shenzhen, the massive shutdowns that we've seen where people are locked up for 3 weeks or more so far. And it's starting to impact economic numbers. You can see in this chart here, the black line is 2022 steel inventories. Normally should be falling due to seasonality. It's not, and that's because production's slowing down across the country. And that's also showing up in the sales manager index, which you can see now is drop below that 50 line, and really a sharp decline. It's probably going to keep getting worse, certainly for the next couple of months. And then finally, a couple of charts about ships. And we know just how, there's this pretty dire situation in terms of transport and logistics. You can see that red line there, the peak that we're at the moment, compared to where we've been in previous years and other sort of little lockdowns. We're at unprecedented levels in terms of the number of ships waiting, sitting on the sidelines. And so what does that mean? That means that there is demand on the cost side for businesses. They're going to pay more for freight. There's delays. We're going to see margins getting squeezed. And so this final chart here, operating margin for the S&P 500, just ticking down a little bit now. Key factor is that ticking down off record levels. Again, margins have not been at these levels ever, and certainly not in any recent time that we're aware of. But I'm pretty sure ever. And so when they start rolling over now, you've got this margin squeeze. It does mean the outlook is, a little bit uncertain for the economy anyway. Question is whether that froth coming out of the market has been sort of enough to provide any value there.
I've also had a quick look at, obviously, the housing market, and we're seeing a big deceleration in loan application. But I think housing's quite interesting. There is still a bit there for the bulls as well as the bears. Obviously, the stocks have re-rated. They're probably off 25, 30% from their highs. But then, of course, you go to the supply side of the housing market and, inventory available for sale is running at 2 months, which is right on their lows. It's having a little bit of a rally. And of course, you've got to factor in increased mortgage rates and the affordability. So I was having a little think, if you're average income in the US, 70, 75 grand, you're looking to move up, maybe buy a $425,000 house, put a 10% deposit down. What's the cost, pick up over the last 6 months? So when rates were at 3.5, now they're 5.1. So you've got a mortgage on 90%, 30-year fixed. I reckon that you were, if you bought this 6 months ago, paying about $2,000 a month, $2,050, something like that. Now I think you're probably up to $2,500. And when you think about on the 70 grand income, CPI added to that, I think pretty much now you're 10 grand a year worse off. Now, will that stop people obviously spreading your wings and moving up the property ladder? Not for $500 a month, but it will lead to a big hole in consumer discretionary that is going to show up somewhere.
Yeah.
Well, that's interesting, Ed. And sorry, yes, Chris, go.
I was just going to say, it just looks like you got a visitor in the pool.
Yes.
Who's
we'll
that?
call security.
We'll get security to clear him out later on. It's interesting you're talking about loans, interest rates, and consumers, because the idea I've been looking at is actually on the long side, and on the long side for a lending company. So Upstart, lending company, what do they do exactly? They're essentially at the intersection of lending and AI. So what they've got is they don't have credit risk as such. 94% of the business they do, the revenue they generate, has no credit risk. What they are is basically an intermediary. So on one side sits 40 banks, credit unions, 150 institutions, all looking to lend money. On the other side are the consumers. 500,000 loans went through their platform last year, all vetted and adjusted and recommended based on their AI technology. Now, we see transformational changes in industries, on a semi-regular basis. This one's probably taken quite a while. Many banks still use the old FICO credit rating system to judge the people they're going to lend money to. This is a simple 5-point credit system. It's based on your credit history. So it leaves out quite a lot of people. So 1/3 of millennials can't get credit because they don't have a credit history. So it's like this vicious circle, which we've all probably experienced something similar at some stages in our lives. So what Upstart does, they've got 1,500 points, data points that they check. They've got $22 million loans that they use as their base. And those 1,500 factors allow them to offer better rates across the board. So for this difference, how does that show up for the lenders and how does it show up for the borrowers? For the lenders, it's fantastic. So putting it through that system compared with FICO, you can, so a lender can have 173, modelling suggests 173% more loans for the same amount of credit loss. Now, if you said, okay, well, I don't have more money to lend, I just want to keep my loan book the same size, using the same platform, you'll have a 75% reduction in credit losses. So very compelling from the lenders, and that's why we've seen such spectacular growth on revenue side. For the consumers, it's very, very simple. It just means cheaper finance.
Actually, out of interest, how far is this stock off the highs, the recent highs?
Quite a bit, Ed. It's down 82% from the recent highs. It was a high-flying tech name. You may have seen one guy on CNBC trying to sort of pitch it at $400, and he didn't really even know what it did. I think he pretty much called the top. That was sort of October. So like I said, down 82% since the all-time high. The changes in its quants quite significant. So if we go back to a year ago and then to that all-time high, a year ago the PE was 212. They were growing rapidly, sort of big multiple you see on that type of growth stock. It got up to 313 times at the peak. And then in that last 6 months, that's dropped down to 33 times. Price to sales, equally huge in the moves. So 17 times price to sales back a year ago, got up to 33 times, currently at 4.3. All the while during these price moves, as you can see from this chart on the screen, earnings were going up at a very, very steady pace. And so we're expecting that to continue. Sales in particular. So the top line is key for this company, I think. It's been growing rapidly over the last 8 years, the last 2 years of which it's been listed. Forecast sales growth for the next 3 years, we're looking at 65, 37, and 45%. Now, that revenue is basically a rough 50-50 split. It's all fee income. They do get about half those fees come from marketing or referrals into that bank and lending network. And the other 50% comes from fees when loans get originated. Now, there is a couple of small components, but that's pretty much, it's a sort of two business or two revenue streams business at this stage. Now, on the earnings side, this next coming year is actually going to be flat. And after that, 40% and 43% is what's forecast. Now, the flat earnings is due to large expansion, and that expansion is into the auto lending market. Now, this market is about 8 times the size of the consumer finance market that they've been operating in, but they're just stepping into it now. So the company's forecast that they're going to spend quite a lot of money on tech, on developers, and as well as marketing. And in the early stages, they'll have to warehouse some loans until they get to a critical mass, and then they'll offload those in the same way as they always have. And some of that may be securitization, which is not what they do a lot of. Now, they expect this business to be $1.5 billion in size by the end of the year. So that's very, very substantial, but it's going to require sort of fairly massive investment. So this next little while, earnings flat for this year. I still think they can surprise on the upside on sales. As Ed was talking about, in those rising rates and the impact for home borrowers, of course, that's going to be happening in consumer markets and auto markets as well. However, I don't think it's going to be sort of showing up in this quarter now. I think it's probably going to happen a little bit further down the track. And so I guess the other thing, also there's a couple of other things. It's a huge cash generator, 170 million last year. It generated more cash last year than it burnt during its 8 years of being a private company, working through the startup stage. And so they're going to keep doing that. They've got loans on their books, a debt facility. So they've got about $900 million in cash to really ramp this business up. And it's grown from just 2 people, so 2 credit providers, to 40 over the last year. There's about 5,000 to 6,000 banks and credit unions in the US that would likely benefit from using this product. I guess the other thing is, it's not without risk. So one of the key risks is exactly what Ed was mentioning. We're in a credit cycle. It is a cyclical business. Rates have gone up. They'll probably go up 50 basis points at the Fed level this coming month, and who knows how many through the rest of the year, but 9 rate rises are factored into the markets at the moment. I think offsetting the inevitable cyclical component that they're going to face, the headwinds here, is just rapid market share growth. And that's showing up in those forecasts. That's what the market's expecting. And I wouldn't be surprised to see them go even better on the other side. And the other factor is, as I said, 94% of their revenue is not taking on any credit risk at all. So it's not like a buy now, pay later company where you're taking on that credit risk and you're trying to offload it. These guys just don't have that. So that provides me with more comfort. The other key risk, as I mentioned, they're growing pretty rapidly this year. So they've gone back to a reinvestment phase. Those costs could come out higher. Now, I suspect they're probably going to be able to manage it quite well in line with the revenue that comes through. But sometimes you do need to put those costs in up front. So there is that possibility that earnings number comes through a little bit weaker. But I think I think we can deal with that. When the stock's down 82%, it's back to a level that I think is probably factored that in. And the final factor, with to a degree taking their view for granted that they've got this fabulous AI system. Now, they've grown rapidly, and one could argue that we've been in really low credit environments, so they've just been aggressive and lucky with a bit of growth at this point in time. But I was looking at some of the securitizations that they have done in the past. So a pool of assets that do trade, and they have a structure and they have a time frame, and they also have in there an expected default rate. And so the ones that have come through from Upstart are actually significantly lower. The realised default rate is way lower than the FICO expected rate. So it suggests to me that they really do have something that's working quite well. The final risk is just with those rates environment, does the model work as well? We haven't seen that yet, and they're going to have to deal with that. Well, they did work through the whole COVID situation where unemployment went to 14%. So I think they should be okay. And I guess the final thing before we sort of get to a trade structure is lending clubs come out and they've got a similar business. It's been growing quite well. They had a big beat in their Q1 earnings, beat by 13 cents. And it's a pretty big beat on their earnings number. The stock's up 20% pre-market. And that's the sort of moves that I would expect for Upstart. Their last three quarters have been big beats, 75%, 89%, and 149% going back three quarters. The moves have been equally as big. So 35%, down 18% on that 80% beat, and then up 20% on the 149 beat. Now, the down 18% came for a period where the stock had rallied very aggressively into that result. So it moved from $140 up to $400 in just the space of 2 months. It eased back a little bit ahead of the result, but we're still trading at $333, dropped to $256. So where are we now? Back to 71.5, basically, with results due out May 9th. Short interest has really picked up as well. So I think it's well set up for the potential for asymmetrical returns, something big on the upside, should they come through with a beat. Of course, in this environment, as we usually talk about, I don't like to take on risk that I don't know what it is up front. So my structure, I'm looking at an $80, $100 call spread. It's going to cost me about $440. It's better than 3-for-1, and I think it sort of stacks up well.
Awesome, good stuff, Anthony. I know lending club's done well, so it's nice to hear another one in the same sort of space as that also has a lot of potential. Ed, let's go over to you. Have you got any sort of stock names you're looking at?
Yeah, I'm having a look at New Fortress Energy, NFE. It's an $8.3 billion gas to storage and transportation company. Basically, it's gas to power infrastructure. So in the LNG market, very briefly, what's liquefied natural gas? Well, you take natural gas, you chill it to minus 260, it liquefies, the volume reduces by a factor of 600, and most importantly, it's not flammable, combustible in the liquid state. So why this is so useful for transportation, especially when you're going over vast distances by sea, where there isn't any gas, obviously infrastructure. It's the only cheap and safe way to transport. So that's LNG, which I hope you already know. Now, before we get into the specifics of New Fortress, have a think about the actual LNG market. So in 2021, the size of the market was 381 MTPA, million tons per annum. And that's expected to grow to 700 MTPA by 2040, an 84% increase. 1 MT is about 1.4 billion cubic meters, or about 47 billion cubic feet. By 2030, the market will be in deficit by about 168 MTPA. Asia's picking up most of this demand, but this, of course, was before the Russia-Ukraine situation. Now, if Europe was to be able to completely substitute Russian natural gas into LNG, it's going to require another 40 to 50 MTPA. All right, so just get a size, always get a sense of scale and size, growth targets, and so on in the actual top-down sector. So if we get into the quants, NFE is in transition. It's extremely high growth. It will have the premium valuation in the sector. So if we have a look at the quants here, you can see it's trading on a PE of only 23 this year, or forward 22, falling to 15 next year. EV to sales about 5.6 times, falling to 3.7 times. But for that, you're getting 66% revenue growth this year, 51% next year, and on the earnings side, up 265% and this year and 57% next year. So you're clearly starting to see some proper operational leverage, meaning earnings are growing a lot faster than revenue. Now, when you have a look at some of the competitors, you can look at a Cheniere LNG. So that's the second biggest LNG player in the market, $36 billion market cap, 10 times multiple PE, trading on 3.3 times 23. So it's not particularly much cheaper than a New Fortress. For that, you're getting revenue growth of 35%, but earnings are actually falling 16% in 2023, and revenues declining by 11%. If you go down the market cap stage and look at something like Golan, GLNG, that's a $2.5 billion company. Again, it's got decent revenue growth this year. It's trading on a sales multiple about 11 times, and we're going to see declining earnings this year and next. So I'm going to leave the quants there, but this, New Fortress is high growth, operational leverage, and I think the valuation is very, very sensible. Last bit of quants, actually, go back to Q4 2021. They finally got some positive net income, earning 72 cents. That allowed them to get to positive full year 2021 number. So what I'm really saying is it's all starting to happen. Q4 last year was the one that got them over the line, actually started to become profitable, and now we're really seeing the leverage coming through.
So commodities, Ed, is usually just dig it up, put it on a ship and sell it. This sounds a bit more punchy on the tech front. Where do they sit on that curve?
Yeah, I mean, it's a good point. I mean, obviously with the premium valuation and growth in effectively LNG means you've got to have the tech handle, and this company clearly does. And it's in transition at the moment. But currently, it's really just a tolling business, a leasing business. So they own the value chain once you get hold of natural gas. So they'll liquefy it, put it on a supply vessel, and then they'll ship it. Okay? So they split this tolling business into terminals and infrastructure. So their clients can just be natural gas producers, right? They will use their facilities to get their product into LNG format and then obviously ship it to their end markets. Their end clients are also Brazilian power stations. They are aluminium smelters, anyone who's obviously using gas. The second part of the tolling business is just shipping. So they now own about 29 vessels. So they can lease these out on long-term contracts to their clients, or they can obviously move it into the spot market for shorter duration business. So that's the old business. The transition is coming because they're going to become fully integrated. And they classify this as the merchant side of the business. But basically, it means you're producing and owning your own gas. And they're doing this all offshore. Now, we've got to look at what the old process would be if you wanted to set up a liquefaction plant. It would be onshore, lead-in time's about 5 years, costs about 1.2 billion, and all the environmental issues of building a massive plant. Now, with this fast LNG, the lead-in time goes down by 50 to 70%, costs by 30 to 50. And because you're effectively installing a liquefaction processor onto an existing risk, the incremental environmental effect is minimal. So this fast LNG is really what's going to drive this company. Now, in the tolling business last year, their volume was 1.4 MTPA. They've got their first big project, 16 kilometers off the Louisiana coast, that should be coming online early next year. They've recently put in all the permits. They've secured all their long-term procurement. They're starting to build the modules. So this is happening. They haven't got a supply side issue to get this project off the ground. In this geopolitical climate and with US policy obviously supporting LNG supply into Europe especially, this is, well, nothing's a sure thing, but it's, we feel pretty good that this is going to get done. They'll start operations in Jan next year, and first LNG for the market will be at the end of the first half, so about 15 months away. So this is going to move the business from 1.4 to 4.2. There are so many projects this company has got going on. Obviously a huge opportunity as well as potentially a threat. But their 2-year plan is to get up to 11 MTPA. That's why this stock clearly warrants a higher valuation. And I think there's always upside pressure in earnings. Pricing at the moment is very robust, from everything from the liquefaction process to obviously shipping rates, and every part of the value chain they're pushing through higher costs. They've also got a energy transition hydrogen business, but we're not going to get into that now. The real nuts and bolts of this is tolling and now transitioning to a fully integrated LNG stock. What are the risks? So many deals, quite a lot of debt. They've strapped it all on. Debt's gone from 1.5 billion to 4.9, call it 5 billion. Debt to equity ratio 2.25. So that's not low. Obviously, we talked about rates and higher financing costs. They've got no pressure in the next 18 months. They've secured all the financing they need, and they should become free cash flow positive. Their financial leverage is 5. Okay, so there is risk on the balance sheet. At the moment, everything's in hand. Their debt recently got upgraded to BB minus. Okay, still a long way to go. Who's running the company? A guy called Wes Eden, actually a financial guy, ex-Lehman and BlackRock. He knows markets, he knows bond markets, he knows leverage. Perhaps not well enough, actually, if he was at Lehman's. But nevertheless, he's executing brilliantly. And what we need, if you're buying a new fortress, you're not buying higher gas prices. You're buying transformational growth, which is more important, really, or as important as the actually underlying spot price is execution. So far, so good, but there is risk. And obviously, with so many deals in all parts of the world, execution risk goes up. They've gone from 2 operations to about 14. They've got 4 in the Caribbean, 6 in Latin America, 2 in the US, 1 in Europe, 1 in Asia. So just to wrap it all up, high growth, obviously structural demand. There's a structural deficit of demand in the underlying market. You then got Russia, Ukraine, adding that extra demand for LNG, a market that's already been in sizable deficit in a few years. Projects do take years to come on. I don't think the last McKinsey report said supply demand will balance between 2025 and 2026, but that's, of course, if there isn't any major escalation. In terms of structure, they've got earnings coming up on May the 5th. I played the September 40, May 45, 2-for-1, a standard ratio calendar call spread, but I'm only using half of my net spend on that structure. The other half, I'm just going to buy September 50 strike calls. Now, in terms of entry point, the stock's around just under 40. It's off a high of 45. In terms of the spot market, it's obviously well off the real panicky spike, and it's just sitting there. So it's a reasonably good entry point, I think, for New Fortress in the current market setup. The reason why I just want half an outright long in September 50s is to give myself some tail risk. We've seen recently that Russia, have altered the supply dynamics into Poland. Who else was it?
You've got me. I knew Poland.
Anyway, Poland plus one other. So clearly, we're all aware that escalation is only a day away. And it's not a zero probability that we're going to see an absurd spike in the underlying market. Clearly, that's going to be a risk-off environment. So I've just got to make sure that I've got some cover for other parts of my book. New Fortress Energy.
Good stuff. I think the other one might be Bulgaria, actually. Not sure. Not certain on that.
There we go.
There we go.
We knew you provided the answers that we can't sort out. Well done.
Okay, gents. Well, the sun is setting on us, as we can see over your side. So we better wrap it up there.
Music's about to start. Thailand is beckoning.
I was going to say, we better wrap it up because you guys will have dinner and drinks and God knows what else to move on to tonight.
Ed's got to get his dancing shoes on.
An early night in.
But it's been great to have you guys on. I know you're out in Thailand, you're doing God's work, creating the next batch of institute traders. So thanks for making the time again on the show. And great to see a little insight into Anton's new pad as well. I know we saw him come across the screen earlier as well. So good to see you guys all together. But that's it for today. I hope you guys all enjoyed watching this episode. Make sure you join us next time for another episode of What's on Your Mind in a couple of weeks' time, and we'll see you then.
All the best. Cheers.